There's a moment almost every new investor experiences. You start with good intentions. You open the account. You set up the transfer. Maybe you even feel proud the first month it goes through. Then the market dips. Not dramatically, just enough to make the numbers turn red. And suddenly, what felt like progress feels like loss. You check the app more often. You refresh. You do the math in your head. This isn't working. And somewhere between impatience and anxiety, the thought appears, maybe I should stop. This is where most people quietly quit. It rarely looks dramatic. They don't always close the account entirely. Sometimes they just stop contributing. Sometimes they sell during a downturn and promise themselves they'll get back in later. Sometimes they switch strategies constantly, chasing whatever feels safer in the moment. But the pattern is the same. They leave too early, not because investing doesn't work, because they misunderstood the timeline. We're conditioned to expect fast feedback. Work harder this month. See a bigger paycheck next month. Post something online. See engagement immediately. But investing doesn't reward short-term effort. It rewards duration. Compounding is slow at first, almost disappointingly slow. If you invest a few $100s a month for the first year or two, the growth barely feels noticeable. The interest earned looks small. It doesn't feel life-changing. And because it doesn't feel dramatic, people assume it isn't powerful. But that's how compounding works. The early years are the quiet ones. Here's the part most people don't emotionally grasp. Compounding is backloaded. In the beginning, growth mostly comes from your contributions. Later, growth comes from the growth. But to get to that stage, you have to stay invested long enough. And staying invested is psychological, not mathematical. Because mathematically, long-term market growth has been historically positive over decades. Psychologically, volatility feels like danger, and danger triggers withdrawal. When the market drops 10% or 20%, even temporarily, it doesn't feel like a normal fluctuation. It feels personal. You see, your balance decrease and your brain registers loss. Loss aversion is powerful. Losing $1,000 hurts more than gaining $1,000 feels good. So even if you intellectually understand that markets move in cycles, emotionally it feels like something is wrong. And when something feels wrong, the instinct is to act. But investing often rewards restraint more than action. There's also impatience. We live in a culture of rapid results. From 0 to 6 figures, double your income in a year. When you bring that mindset into investing, it creates unrealistic expectations. If your portfolio doesn't grow dramatically in 12 months, you assume you're behind. But investing isn't designed for 12 months. It's designed for decades. If you measure a 3-0-year strategy in 1-2 month windows, it will always feel unstable because short-term returns fluctuate. Long-term averages smooth out. Another reason people quit early is misunderstanding risk. Volatility isn't the same as permanent loss, but they feel similar. When markets dip, it feels like money is disappearing. But unless you sell, it's a temporary change in value. The problem is, temporary declines test emotional tolerance. If you invested without understanding your own risk capacity, downturns feel unbearable. So you exit, not because the strategy failed, because your comfort threshold was misaligned. There's also comparison. You invest steadily for 3 years. Then someone posts about a stock that doubled in 6 months, or a crypto trade that exploded. Suddenly, your slow, steady portfolio feels boring, underperforming. You question your strategy. Maybe I should be more aggressive. Maybe I'm missing out. Chasing speed disrupts compounding. Switching strategies resets momentum. And jumping in and out of markets often locks in losses rather than allowing recovery. Consistency loses to excitement in the short term, but excitement rarely wins long term. The turning point comes when you shift your measurement. Instead of asking, how much did I make this year? You ask, am I still consistent? Consistency is the lever. If you're contributing regularly, staying diversified, and resisting panic during downturns, you're already doing the hard part. The returns are largely a function of time. Time in the market matters more than timing the market, but time requires patience, and patience requires emotional regulation. Practically, one of the simplest ways to prevent quitting is automation. When contributions happen automatically, you remove the need to decide each month. Decision fatigue decreases. Emotion has fewer entry points. You also reduce the temptation to wait for a better time because there's always uncertainty. Another protective layer is limiting how often you check your portfolio. Daily monitoring amplifies short-term noise. Quarterly reviews often provide more clarity and less stress. Your strategy shouldn't change because of a headline. It also helps to zoom out historically. Markets have experienced crashes, recessions, and corrections repeatedly, and yet, over long horizons, they've trended upward. This doesn't guarantee short-term stability, but it highlights a pattern. The people who stayed invested through downturns historically benefited from recoveries. The people who exited during fear often missed the rebound. Missing just a few of the strongest market days can dramatically reduce long-term returns. And those strong days often occur near the worst declines. So quitting early doesn't just pause growth, it interrupts it at critical moments. There's another psychological benefit to staying invested. It builds trust with yourself. Every time you resist panic and stick to your plan, you reinforce the identity of someone disciplined. You stop reacting to every fluctuation. You begin seeing volatility as normal, not catastrophic. That mindset shift reduces stress because uncertainty becomes expected, not shocking. In the end, most people don't quit investing because they're incapable. They quit because the timeline feels too long and the fluctuations feel too intense. They expected fireworks. They got slow accumulation. They expected steady upward lines. They got waves. But wealth built through investing isn't dramatic most of the time. It's gradual, almost boring. And boring is hard to stay committed to, especially when the world celebrates speed. If you can understand one thing clearly, let it be this: investing isn't a test of intelligence. It's a test of patience. The math is straightforward. The emotions are not. If you measure progress in decades instead of months, volatility looks smaller. If you automate contributions, inconsistency shrinks. If you align your risk level with your tolerance, downturns feel survivable. Most people quit too early, not because the strategy was wrong, but because they underestimated the psychological side of staying in. And staying in quietly, consistently, is what allows compounding to finally show its power. Not in year 1, not in year 2, but in year 10, year 20, year 30. That's when the quiet years reveal what they were building all along. Most people don't quit because the math failed. They quit because the emotions felt heavier than the strategy. The dips feel dangerous. The progress feels slow. The excitement feels somewhere else. But investing was never about excitement. It's about consistency. Patience protects you. Time multiplies you. Compounding is quiet at first. Then one day, it isn't.